All right. So, some of you guys may have noticed the original idea, the original title of the class was going to be areas of interest. And the reason that I changed it to liquidity is because I think that it's more important that you understand liquidity because without that, I think that sometimes, using points of interest can be a little bit more harmful than good because they're a little easier. So let's just think about it like this. If you just understand what an order block is, then you want to trade every order block. If you're looking at price from the perspective of just fair value gaps, and you're going to want to short every single fair value gap, right? So, but if you understand liquidity, you may have not shorted this fair value gap. So, for example, in this piece of price action, we are always moving from one area of liquidity to the next. So we're going to start from down here, right? And this is where we get our smart money reversal. And some of you guys may spot a pattern within this that we're going to go over, and feel free if you want to drop it in the chat to call out before I do. But in this pattern, we have our smart money reversal. So our smart money reversal is whenever we get that displacement break of structure that we were talking about after taking liquidity. So when you see this, when you see the market make this move, right, the classic smart money concepts entry model, right? It doesn't always have to be used as an entry model. It can be just used as a signal to switch bias, so to speak. So, for example, once we have this pattern, and I'll let you know what it is in a second, but we have a reason to be bullish on the lower time frames. Now, if we look at the higher time frames, we also have taken out, let's look at a 4 hour. We've taken out a massive liquidity pool, all right? And then we've taken out liquidity again. So we have a reason to look for a bullish narrative. And so this smart money reversal down here would hold a lot of strength because like we were talking about structure, when we get this displacement, that's kind of where I asked myself, were the institutions involved in this? Well, we took liquidity once here, we took it again, and then we're now sharply pushing back up into the range, right? So whenever we have something of that nature, we understand that this is likely to give us a bias switch. And before I get too far into it, there might be some people, I doubt there are really any watching that don't understand at least what liquidity is from a very simple point, but liquidity is basically just where there are stop loss orders or where orders at all remain in the market. So if we are short here in this piece of price action, where is our stop loss going to be? It's going to be right there, right? If you don't understand or don't trade smart money, or maybe, and it's not just to say smart money, it's not like everybody who doesn't trade smart money is just an idiot and they just use terrible stop losses. But a lot of people, if you just ask somebody who is newer to trading, they're going to say this is a sell wall, right? Oh, price hit here, hit again, and can't get above it. So they're going to put their stop losses up there. So if we are a market maker and we're looking to move price towards liquidity so we can participate, because whenever you are pushing a button to buy and sell, whenever you and I buy, whenever you or I buy or sell, it's very easy. We just push a button, price, it doesn't necessarily have to move a lot, or it's not going to move a lot because we did that. And the reason for that is we're not soaking up a lot of liquidity. So the reason price moves is just moving to where there are orders. So this is where footprint traders come in, is they look for a lot of liquidations. And that's similar to what smart money is looking for, because we're just looking at the market as this machine that it has to keep moving. It has to sustain. It has to, price has to move in order for people to want to be involved. So we have to move to where there is an ability to move. That makes sense. So if we're moving from, let's just think of it. I've used this example with you guys before. Let's just think of it like look, all these little liquidity areas as like a pit stop, as a gas station. And this car is on a never-ending road trip. And in order for it to keep going on this road trip, it has to stop at these gas stations. And it goes from one gas station straight to the other. And that's all it's really traveling to. There's no destination because the journey is never going to end. So it's just traveling between one area of liquidity to the next. And that's always happening. And now a lot of people misunderstand that when they're starting. This is what I misunderstood, is they think that, you have this big, massive move and you have buy side, sell side. And, ICT says something, you take the sell side, you go for the buy side. Now, this is true, but on a much smaller scale. So let's just use an example on this bit of price action. So let's say here, We went from sell side, we took sell side here. So where's price going to move straight towards? Is this going to be our buy side we're moving towards? Not necessarily. It's going to be right here, right? Hold on. I'm going to sneeze. Excuse me, guys. Hope I wasn't too loud. But we move, we're expanding up towards an area of buy stops, right? And any of these areas, it doesn't have to be, this has to be the only buy side. There's going to be buy side above this high. So what I look for is where do we move off of aggressively? First off, where are clean areas? This is easy, right? Like these equal highs, that's easy liquidity spotter. But other areas, where do we move up aggressively? We moved really aggressively off this right here, right? And if we're looking at this to be a reversal, we're under an old liquidity pool. So there's going to be liquidity all the way up on this move because each push down is manipulated. So that's what I want you to think about is if the structure is telling us, overall bullish on a higher time frame or telling us that we might be in retracement mode, even if we're bearish, then all of these down pushes, in a bullish market, all of these little, drop-based drops, these are all just little gas stations. Think of them like that. All these little areas, right, where we move expansively off of because those are manipulated. Because again, if we're bullish, then any down move is manipulated. So think of it like that. If we're bullish and price is pushing down, and when I say bullish, I'm not saying that every market structure on every time frame is bullish. I'm saying that right now our bias on this time frame, the 5-minute time frame, is to go up. So that doesn't mean that we are in an uptrend, necessarily that we're just never ending, have to look for only bullish struck or bullish price action in an uptrend. But let's say if we're in a downtrend and price is down here and it's done this number, that's still bullish to me as a day trader or as an immediate bias because we're not necessarily investors when we're trying to trade these markets intraday. That would be, yes, this is still a bearish market, and maybe your strategy doesn't trade unless it's pro trend, and that's fine. I have strategies like that too with swing trading. But if I'm trading, I'm trying to be very precise and I'm trying to get opportunities more than, once every, blue moon. I'm looking at this as bullish price to me in this day because price is telling me we're moving up. So right here, that's bullish to me. Now, when we get up in here and we switch down, right, that's where I become bearish, right? So whenever we're looking at this piece of price action, we come down and take out a low. So this is this is our last little rate on stops. Now, again, we didn't know that until this happened. This is a great example of displacement. Full-bodied candles pushing right through a high and also disrespecting, if you just look at it like this, some people might say this is an order block or this is supply, right? Or maybe this whole thing. But again, it's all about context. We're not looking for it to continue being bearish because, again, at 4 hour, already taken liquidity once here, and now we came down, and then we took it again in the lower time frames, and we reversed. So you're not looking at that in that context. But this is a good example of not respecting order flow. If you guys watched my video on YouTube about bias, I talked about how to use order flow in the sense of what order flow is being respected. Was this a bearish order block? No, we blasted right through it, right? Then engineered liquidity above it, and this is a breaker at this point because it's the last up candle before a raid on sell side liquidity. So when we look at all these lines, if you've been watching this, I've been talking, price is just moving from one area of liquidity to another. So for instance, we move from sell side here, push up into the buy side. The next area of buy side is right here. You could say low hanging fruit was here, but this would be a very immediate draw. So we are pushing up, drawing into this high. What have we done? Hold on,